Hello and welcome to this very special discussion where we are going to decode Budget 2017 and how it impacts your wallets and your investments. Joining me today are Nikhil Bhatia, partner at PwC, and certified financial planner Kartik Jhaveri. Thanks very much both of you for joining in today. So before we get into the nitty-gritties, let me start by asking you what your initial thoughts on the budget were. Nikhil, let me come to you first. We saw some relief coming in at the lower end of the tax slabs. Capital gains on equity wasn't touched, which was a relief for the markets, but you did have capital gains on real estate that came in. Then lots on the housing side, so to speak. Overall, it was a stable budget?
I think fairly stable, not too much of tinkering, which is good. One always expects more. I think all taxpayers expect a lot of relief in slab rates and stuff like that. But I think by and large remaining steady, so which is good, maintaining the fiscal deficit.
Right. Kartik, what about you? What were your initial thoughts on the budget?
So, I was thinking that there would be 3 or 4 very specific areas where some action was required. And I think to a large extent that has happened. So benefits that needed to be given to the rural India, to the poor and underprivileged, that had to happen. So that has happened in a huge way, doubling of farmers' income, etc. So that was a great move. Monetizing of government assets, government land, the IPOs that they are planning.
Yes.
So that's a nice way to raise revenue for the government. So I think that was a very, very proactive and a good step that has happened for us. The other thing was infrastructure. So in terms of infrastructure, in terms of developing the infrastructure, the allocations that were made for roads, for shipping, for projects that needed to be really taken off and investments that had to be done there, that's happening, which is nice. Digital push should have been a little more, I was hoping because we are trying to change behavioral patterns of people here. I was actually hoping that since the mission of the government is Digital India, so I was hoping that they did a little more in terms of incentivizing, giving some rewards to people who really went digital. So it's great that they've brought out some numbers of how many people have started using it, but I thought a little bit of effort would have been nicer there. And the last area which I was expecting some serious action to happen again was the expansion of tax base. Now I know it's easier said than done, but well, all said and done, if there were certain other stronger measures brought in by which they could actually expand the tax base, so then we would actually start the movement of moving from an economy where we are trying to extract the maximum tax out of the taxpayers instead of increasing the tax base and then giving the benefit to the public at large. So I thought a little bit of action there could have really helped. But so that's the only one little area of disappointment. I didn't see a very concrete measure of how they are going to expand the tax base. Though the respected finance minister said that they are trying to do it, but I didn't really see how.
There was no real roadmap for that.
So there was no roadmap to that.
Yeah, right. But Nikhil, just taking that point of cashless and digital forward, do you think, as Kartik was saying, it's not enough yet what they've done? Because we're really at an age where digital is the way forward. We've got financial products being bought online in a completely paperless format. So many other things that the government is trying to push the entire digital India. But do you really see that happening in terms of where we need to be versus where we are?
I think to Kartik's point that there should have been more incentives for giving a percentage off and stuff like that, which makes it positive kind of incentives to go digital was not there. There's a lot of penalties for not going digital, and the GST coming through, demonetization, all these are steps all towards that whole cashless economy. And I think somewhere in the system it'll happen. But yeah, the thrust could have been a bit more by way of positive incentives in terms of.
Right. So let's start with the income tax bit. Nikhil, it's been brought down from 5% from 10% for the lower part of the slab. But at the same time, you've still got these surcharges and rebates and all of that. Do you think that we still need a far more simpler structure overall as far as the taxation, income taxation is concerned?
I think the structure is simpler, taking away some of these other minor exemptions. To my favorite, even 8IC can be taken away and just give a big lump sum basic exemption and then have another big chunk at 10% and 20. So let's say 25 lakhs and then 25 to 50 lakhs, 20% and then go to 30%. For that kind of stuff, leaving a lot of money with the individuals who either spend or save, which is both good for the economy, but leaving the choice with the individuals to do what they want rather than do tinkering. This is good for the marginal taxpayer, but I think it could have been much larger, giving much more spending power to the individuals.
Right. Kartik, I want you to break this down really in terms of the actual benefit after what FM has announced that one gets. You spoke about taking the ATC into account and all of that. So just break it down for us as to what's the actual benefit that one gets in hand.
Starting from a tax-free income zone of say 2.5 lakhs,
Right.
you add to that your section ATC benefit, which is 1,50,000 rupees. So now this is something which is very popular. Most of the salaried people would more or less cover the ATC from their employees' provident
Yes.
fund contribution, and the non-salaried people are obviously doing PPF and other similar sort of instruments by which they reach that 4 lakh threshold. So what is now going to happen is that 1 lakh, which is the difference between 5 lakhs and 4 lakhs, on which you were until now paying 10,000 rupees as tax, 10%, is now going to go down to half, which is now 5,000 rupees. Now here also you've got some other benefits. You have an NPS benefit of 50,000. You have a
Yes.
separate section to invest in NPS. So if you actually went ahead and took that as a benefit, then your taxable income is only really the 50,000 rupees on which you're paying 5%, which is 2,500. Now consider that you're a senior citizen. Now as a senior citizen, you have this basic exemption level at 3 lakh rupees. So from 3 lakh rupees, you add 1,50,000 of your section ATC, and then you add another 50,000 from that NPS also. Okay, in that section, if you are going to be investing there, then pretty much your tax is gone. You don't have too
Right.
much of tax to pay.
Right.
So to the lower end of the strata, there is a little bit of marginal tax relief. The 10% bracket is not there at all now.
Correct.
And just to keep things uniform, people between the 5 lakhs to 10 lakhs who were until now going to be charged 20% will have a special rebate of that 12,500 rupees, and then the rest of the tax is going to be payable the way it was calculated even earlier.
Right.
And then beyond 10 lakhs, you have your 30% taxation.
Right. Right.
Well, I have a point
Yeah.
there. You know, the people who are at 5 lakh bracket will find it very difficult to invest 2 lakhs into PPF and block the money.
Yes.
Absolutely.
Which is what I'm saying.
Yes.
You know, open it up. Let people decide if they want to put in PPF by all means. But if they don't want to put it, don't force them to do it because they have got better alternatives or better personal needs which are, you know, compromised. And, you know, they can be spending for X or Y, but for saving tax, they got to put
Correct.
You know, this
a
is-
large chunk of money. It's that 1 lakh is really good for people who are in much higher brackets.
True.
The marginal person doesn't really practically get that benefit.
So essentially, I mean, like the finance minister says that if one used up the entire 1.5 lakhs under section ATC, the tax of up to 4.5 lakhs is zero. That's not really workable. That doesn't really happen in reality,
for people
right?
who have 4.5 lakhs of
They're
rupees
not
are not going to be able to put that
exactly,
money in. So it's-
exactly.
and even if you do, finally it boils down to, you know what, 1.5 lakhs, 10%. So you're saving, you know, 15,000 rupees. 1,000 bucks a month, you know, so
Correct.
it's insignificant. It sounds percentage wise, it sounds, but it's not material. That's why this whole big chunk and saying, look, let them decide what they want.
Right. Right. So just for our viewers, I'm going to break down the tax slabs as of now. So you've got up to 2.5 lakhs, there's no tax. 2.5 lakhs to 5 lakhs is now 5%, which was 10% earlier. Then along with a rebate of 2,500 for up to 3.5 lakhs. Then you've got 5 to 10 lakhs, which is at 20% tax, and above 10 lakhs is 30%. And of course, then you've got the surcharges where 50 lakhs to 1 lakhs is 30% income tax. 50 lakhs to 1 crore is 30% income tax plus 10% surcharge, and above 1 crore is 30% income tax plus 15% surcharge. I've got that right?
Absolutely.
Kartik? Okay. Great. The second part was, you know, what we were talking about earlier, Nikhil, is simplifying the entire tax structure. So he spoke about a one-pager income tax return form for those earning up to 5 lakhs. Do you think that's really enough in terms of the administration part of it, filing returns? Ideally, how should that be for a society like ours?
Increasingly, and you must give credit to the tax department, I think they're going electronic, they're accepting a lot of this voluntary kind of disclosures and self-certified returns. So more and more simplification is happening. They are tracking it electronically, and then they'll go after audits only on selective basis based on analytics and stuff like that. I think that's all happening very nicely. So you have one pager, which is great from, a 20-page form which you keep on filing and you don't know what to do. I mean, I get confused often filing my own tax return, so I don't do it. But so the point is having a simplified tax return saying, okay, no business income, dividend, interest, salary, boom, 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 finish. So I think it's a great way of doing it.
Right. Kartik, your views on this, because I'm sure that, that's one area where you have a lot of people asking you questions and getting confused about this whole income tax returns and filings and all of that. What ideally would you like to see, especially from, and what's the sense that you get on ground from your clients?
So, simplification and self-certification, as well as, the fact that citizens are honest taxpayers, the ones who are paying the tax. So those three things have been going on hand in hand, and which is what we've seen in terms of electronic simplification. But simplification is actually also required from the business and the professional front, because there is just so much of compliance on the ground still that needs to be done. So what's happening is, where it is possible, you are doing the easy part, but whereas the challenge is to actually make it simpler for the income from business and profession, because you not only want them to file the long lengthy income tax return, but there's a balance sheet that needs to be attached with that, and then the balance sheet then for, you just can't put in a balance sheet, it has to be reconciled. There's a lot of paperwork to be done behind that. There are things that a business owner needs to do for even a small business owner. We're not talking of a huge business owner. We're talking of the thousands and thousands of probably millions of sole proprietorships and the small family partnership units and things like that. So there's so much of compliance, advanced taxes that need to be paid, service taxes which needs to be paid, or VAT that needs to be complied with. So if all those things could also be simplified over a period of time, and if a lot of, we've got enormous amount of data which is available at various places today. So if a lot of this data could be populated on the back end itself by the government, by their agencies, then life becomes very simple for the people on the ground. And we are hoping something like that will happen, hopefully, with the GST coming in, because everybody has been now asked to start registering for the GST, whether you have a VAT or whether you have a service tax. So you start registering. Once you start registering, means there will be information which will be available at the back end. I hope they are able to consolidate that.
The other part is that capital gains on equity was left untouched. Were you really expecting something on that to come in this time?
We all as professionals probably build up the expectation, or people in the market build it up much more than, so I don't think government ever said that, but I think there's a lot of stuff. So I'm happy that it didn't do, it's part of keeping things steady and not tinkering with things. But there was one little innocuous, again, clause there which talked about actually capital gains on equity shares, listed equity shares, if they were bought without paying STT, then they will still come up for taxation. So it is not that everything has been left untouched.
Okay.
The equity shares which were bought during a particular period without paying STT will actually come up for taxation. So some of the private transactions that happen, even if they are held for long-term period, now they are listed. For instance, they would come up for taxation. One needs to read the fine print of that, but I think there is some bit of equities which will come up for capital.
Let's move to the real estate space, because there's been a lot of changes and a lot of action there. So we've got 3-4 main points. Let's touch upon them one by one. First, Kartik, let's talk about the changes in the capital gains as far as the real estate space is concerned. The holding period for considering gains from immovable property has come down from 3 to 2 years. Can you take us through the implications of that?
So what happens now is that until now you had to wait for 3 years to sell a real estate, and now that's come down to 2 years.
Right.
But see, to my mind, I don't think this is a huge difference, because ordinarily for most people, when they buy real estate, people like to sort of have a portfolio of real estate over a period of time, you see. So whether it's a salaried person that we're talking about, or we're talking about a individual person, a business owner, real estate or the investment of real estate has been such a great lure for centuries, and everybody wants to have a piece of land which is their own.
Right.
So once people buy real estate, they don't sell it so soon. And so ordinarily they are anyways holding for many years in the future. So to that extent, I don't think there's too much of a difference which has been made to their life. Of course, then if you're talking about people who bought real estate and who are, in some sense giving money to developers and who are buying real estate from a very, very short-term perspective. So for them, it's a little bit of an advantage, because then what happens is if somebody was going to hold between 2 years and 3 years, then that would have been short-term otherwise, and all the income, all the gain from there would have been added to their income, and on which they would be paying the marginal rate of tax, which could have been 30%, which is now not the case, and they will get a little discount on that. So that means after 2 years, if they sell, it becomes long term. But this is for a very small community of people, I would think, who are investors of real estate for a very short period.
Nikhil, I want you to take us through this part about the base period for indexation, which has been changed from 1st April 1981 to 1st April 2001. What really does that imply? How does that change things?
That actually is quite an interesting one. 81 and some probably long overdue, because currently for long-term capital gains on assets held prior to 1981, you could you could step up your cost base equivalent to a market value as on 1st of April 81. And that's 25 years, 27 years from today. What they've done is that they've actually substituted the 81 to 2001.
Okay.
And therefore you will get a step up of your cost, which is long term, really old assets which you've been holding, to a cost basis equivalent to the market value as on the 1st of April 2001. So really the value which has probably, and some of these assets, particularly real estate, which would have gone substantially more, you would get a much higher step up of the cost base, and when you sell, your the capital gain that comes up for taxation is only the difference between your today's market value and the 1st of April 2001 value. So you get a fair amount of relief in terms of the
capital gains really goes down.
Yeah.
Okay.
So that's that's a relief for people who are really holding it for long term and then have made the gains.
Right. Kartik, there's also another loophole that's been plugged as far as the rental income is concerned that we were talking about earlier. Take us through that.
So this is a very interesting option. Now this was very, very widely used by a lot of people who are essentially what we call as the high net worth individuals, people who are high salary earners or high self-employed business earners. So what the provision was that if you actually borrowed money for buying a property, let's take a real example. Let's say you bought a very expensive 5 crore, 8 crore kind of a property and you took a loan for that. Say your loan was 4 crores, for example.
Right.
So even at 9%, 9 fours are 36 lakhs, approximately you would pay interest in the first year. Now, somebody who can afford a loan of 4 crores is obviously paying an EMI of 4 lakhs. And based on the income to installment ratio, that means his income is somewhere in the range of 7 to 8 lakh rupees a month, and which is a crore a year. That's sort of so we're talking of that section of that category of people. So what used to happen is that entire 36 lakhs or the amount which was paid towards the interest, you could actually knock it off from income from other heads, which is income from salary. So imagine you paid 36 lakhs as interest and you straight away saved a third of that, which is 12 lakhs in taxation. So that was a huge benefit which was available. So this is a part of the fine print. So now what's going to happen is this benefit has been now reduced to 2 lakhs, and this is just to sort of bring it in parity with somebody who was not using that property as a let out property. So what used to happen is on your self-occupied property, you have the limit of 2 lakh rupees as interest payment, which you get a deduction for. The same logic has been applied for all your secondary investments, which is your second property and your third property and your fourth property, which is nothing but your investment property or properties that you bought to either let out or just keep it for your own consumption. But for all those properties now, the interest cap that you will get as a deduction from your income is only now 2 lakhs. So earlier there was a huge amount of tax saving that used to happen, which is now not going to happen.
Not possible.
I have a different take on that. So it's actually going to hamper or reduce your take on the housing, because to that extent the demand comes down. But if you were to apply the GST principle or the value added principle, every rupee of interest that you are paying, somebody else is paying tax on that.
Right.
So I think in fairness, and I think in real time, because it's really the interest that you are paying against your income. And if you are earning income, if a businessman is allowed to claim deduction for against income that he earns, why should not an investor in a property be able to claim that as a deduction? Because there's somebody else paying tax on it. So I think same way as, and to have taxed notional income on my self-occupied property by itself was a challenge. And globally, a lot of countries actually give deduction for housing interest that you get. So it's again on the same principle, somebody else is paying tax on it anyway. So it's an incremental value added tax if you were to look at it that way. So to my mind, while it was a planning avenue, it was also a real expense that you are making in investment. And today I would be, if I was to go out for investing into another house, I would be disincentivized. So
that window is closed now.
Yeah, that window is closed. But
Correct.
Again, you're doing it for a planning purpose or whether you're doing it as a real investment, and that is one of the other investment cycles which is actually going into reverse. So you can look at it either way.
It falls into the agenda of the government for incentivizing people who actually want to use end users of housing rather than people who are just buying it.
Yeah, but it's again one of the things saying, why should government tell you what you should be doing? It's your money, you put it in. Somebody else is paying interest tax on it
But
anyway.
then for people who actually want to buy houses for their use, the prices don't really come down.
No, but then what is happening, to my mind, and he can correct me, that if there are too many people buying this, then the rentals are coming down really well. So now today rental is becoming a lot more affordable. I mean, you're talking 3-4%. So people with high net worth are buying. So I would say let somebody else pay for the asset. I will just use.
You will enjoy it at 2-3%.
So it's
Yeah,
economics will take care of it. I don't think government needs to intervene. But that's my view.
Right. Kartik, also you were mentioning that there's a TDS that will have to be paid if the rental income is above 50,000.
Yes, so that's another provision which has been added. So what is happening is, if you have taken a property on rent, and if you are paying a rent of more than 50,000 rupees a month, which is essentially 6 lakhs rupees a year, then you will have to deduct 5% as a TDS, which means, for example, if you're paying exactly say 6 lakh rupees to your licensor, the person whose property you're using, you will have to deduct 5% out of his earnings, which is on a 6 lakh, 5% works out to 30,000 rupees. So which means in the 12th month of your rental, you will pay him 30,000 rupees lesser. You will pay that on his behalf to the government.
Okay.
So this is just again to trap the whole situation where a lot of people would actually not pay this tax, or would claim certain exemptions, or would not have taxable income and so on and so forth. So they come into the net one that they are earning all this money, and of course this limit is above 50,000 of rental properties per month. But it's an interesting provision, it's a good provision, and the good facility that you have is that you don't have to cut every month. You can just make a single lump sum payment at the end of the year, or one time in the year, in the financial year obviously. True. And depending on how many months will fall into your first financial year of the arrangement of your rental property. So you'll have to just think about that, and it's a single statement come challan, and it's easy. You don't have to apply for a 10, you don't have to do all that tedious compliance procedure. It's rather simple. You just have to cut away 5% and pay it to the government, and obviously give the challan to the to your landlord.
But procedurally, I think one more process. So against your point of saying, can we simplify for people? I think complying with TDS provisions and then managing defaults, because what is happening is on the implementation stage. If and when a TDS provision is not complied with, the enforcement against the deductor is huge. The penalties for non-compliance, the prosecution notices that keep on coming in, and you are actually acting as government's agent. You are actually doing a service, and rather than paying you 5% for that service, you are actually getting penalized. So I think that particular process for individuals can get quite tedious, and I think to the extent that now people are going cashless, every bank deposit is going to get tracked. Hopefully this should go away finally, and let the individuals who are receiving pay their self-assessment tax, because each of these process, while for government it's a good way of gathering and making sure things don't slip through the cracks. On the other end, when they are able to now track all the banking transactions, hopefully this should actually go away, and it should be made less and less cumbersome for individuals to be doing this TDS, because in practice it's quite a complicated process.
Not only that, Avni, there's another very interesting thing which I want to mention to you viewers, just exactly what Nikhil said, that it's a cumbersome activity, it's an additional process, but the implication of not doing this process is also quite severe. So for example, I'll give you a relevant example. Recently we've started paying TDS on the properties that we are purchasing, right? So if you're a buyer of a property, you need to pay TDS on behalf of the seller, and if you don't do that, even if it's a, let's say, builder property where you're paying installments to the builder, if you don't deduct, electronically they are tracking your transaction, and for every day of delay you are being penalized. And you have to pay a very hefty fee if you actually have not complied with it. If you've been ignorant about it, one fine day there will be a big, huge, fat bill of penalties, and the penalties actually could be as large as your tax sometimes. And more. So people need to be very, very cautious and careful about this provision. And if you have a property that you have taken on rent, it is your responsibility to deduct it, and you must do it. And you should not actually miss up on doing this thing.
Right. Another interesting point that, it was just one statement he made, he said that we also plan to extend the basket of financial instruments in which capital gains can be invested without paying tax. It was just a statement he made in passing. Your thoughts on that?
This is in relation to investments that you can make out
Yes.
of your long-term capital
Yes.
gain in rural electrification bonds and a couple of other instruments, which basically are bonds which pay you interest, which is taxable, and but at least you save your capital gains if you invest and hold them for a 3-year period. So there he's going to they're talking about notifying more such instruments. So it gives you an option and possibly other sectors also to float such bonds, which will then attract the capital gains as investments, and it's a fundraising opportunity.
Right.
For this. So it's good.
The other part, Kartik, was that NPS was hugely expected. NPS will be bought on par with PPF and EPF, but that didn't really happen. From a financial planning perspective, what is your view on the NPS? There was some small fine print announcements that did come through, but overall, what is your sense? What is your advice for NPS?
So my advice for NPS has always been, that if you're a salaried employee, and if you have the option of your employer starting an NPS account for you, please go ahead and do it. Because that is, even in the current form, with the taxation of NPS right at the end, that pot of gold which you are going to have, even if that's going to be taxed to a certain extent, it's still far better off than you putting money in EPF. The reason for that is very simple. Your EPF rates are at about 8% right now. Going forward, it's only going to go down. Versus that your NPS at least gives you the facility of putting 50% of your money into equities, and therefore your earning potential, or your corpus collection from NPS is going to be so much larger. So if you have that option, please go ahead and do it. From a self-employed person's perspective, you could easily give it a miss. You don't really need to worry about it. You don't need to start a new NPS account. You're better off not even taking that exemption, that deduction that you are getting of that 50,000 is just perfectly okay, because it doesn't work out best for you because there's taxation, and then instead of that you'd rather put your money into ATC products, and then other than that you start doing open-ended investments where you can go up to 100% equity.
Right.
Because in an NPS product, if you're not going to go to that option G, which is that 50% equity option, then it's not worthwhile doing NPS at all. Then you rather not do it.
Correct.
And if you wanted to be in bonds, and if you want to have a lesser allocation to equity, just stay away from NPS anyways.
Right. Kartik, what's the clarification that you would be looking at as far as this LIC pension scheme 8% guaranteed return is concerned for senior citizens? Because aside from that, there was no really other benefits that he announced for senior citizens. And also, how would this sort of stack up with, as we were talking, the other pension schemes that are there in the market?
So the first thing to understand is, yes, it's guaranteed 8%. That's really nice, but it's going to be taxable. So it's not tax-free.
Yeah.
That is, just take it as a blanket assumption like any other pension product. This is also, it's going to be an annuity, so which is therefore as salary and therefore taxable. The other thing is, this is just to sort of, soften the impact of the falling interest rates. Because of demonetization, the rates went down. The other thing is, as soon as our economy starts improving, the capital investments will start, the cycle of investment starts beginning, automatically interest rates will go down as inflation is under control, so on and so forth. So there is more expectation for interest rates to go down even further. So therefore, there had to be something to at least pacify the senior citizens who are now kind of a deprived lot, because until a few months ago, they were earning about 8.5, and now they're going to earn about 7.5. So 1% fall is quite a big fall. So they're trying to cushion that a little bit. Third, I think this is going to end very soon, because the government obviously can't afford to give you 8%, where let's say the interbank rates are at about 8%. So in that sense, this is a part subsidy which people are going to get, and this can't continue for so long.
Right.
So this is just probably for a year or 2 years.
Okay.
I would not even be surprised if in the actual guidelines there's a limit on this. Just the way we have a limit on senior citizen scheme for 15 lakhs, postal has a limit of 6 lakhs and 3 lakhs. So there will be some limit on this as well. So I don't think you can indefinitely, or for any amount of money you can go ahead and take the advantage. Please be very cautious. And any pension scheme, mostly with LICs, you don't get to encash it ever. So it's like a one-way street. Once you give the money, more often than not, you will be into a product which does not give you any sort of liquidity. It just gives you a little bit of money as interest, and that's about it on which you're paying taxable.
Kartik, what's your advice as far as ETFs are concerned? Because he did say that ETFs would be used for further disinvestments of shares, and the recent CPSC ETF also did extremely well. For retail investors, do you think it's a good avenue?
So I have a mixed opinion on that. The last CPAC fund, which did really well, was largely because almost 50 to 60% of that was concentrated in 2 or 3 companies, 3 companies to be precise. And these 3 companies actually did pretty well, and they did well because crude oil prices were going down. because they were going down, so these three companies actually made quite a lot of money, and therefore the portfolio did some really nice, handsome returns. But I don't think this is constant and it's going to continue forever. However, I like the philosophy that, you know, we are introducing products and by which you can invest into a variety of PSUs, and obviously they want the PSUs to be more independent, start really focusing on profits, start competing in a profit environment, in a competitive sort of an environment. So to that extent, I would reserve my comments right now. Maybe I'll wait for some of their scheme offerings to come through, see the portfolio composition, see the choices of companies that they're buying in these ETF plans that they're going to launch, and thereafter we'll take a call. However, because we are on this subject, I definitely like to also make a little mention here. Some of these IPOs that he's talking about, the finance minister is talking about, that are going to come up, IRCTC for example, these should be some great opportunities which are opening up. So whether or not you apply for these ETFs, you should definitely try and apply for some of these very, very successful PSUs that we've got and which are going to be monetized by the government. So I think that's a definite yes to that.
Nikhil, so overall it seems as if the finance minister has really tried to plug in some of these loopholes and without getting into too many nitty-gritties, and he's maintained sort of a more broader view of things, you know, the way it stands.
I think the current focus is more on getting GST and other bits and pieces, all the cashless bit out. But I would really hope that at some point in time it still gets further simplified, leave more money with the individuals to decide where they want to invest and stuff like that.
Right.
So far, so good.
Right. So Nikhil, if I had to ask you how you would rate the budget, what would your rating be out of 10?
So I would rate it at about 7. Some good thrust on focused education, infrastructure areas, and I like the plugging of the black economy and a lot of cashless, a move towards the cashless economy.
Right. And Kartik, what about you?
So I would like to put a 6.5 or somewhere around there, because I was wanting a lot more to happen on digital, and I think it's really essential and necessary for India at this time. And the other was expansion of the tax base, which I didn't see too much of happening. But on the other fronts, the infrastructure, rural push, the benefits that are going to them, I think it's all thumbs up to that.
All right, we'll leave it there. Thank you so much for joining in today. All right, that's a wrap on this special discussion of decoding the budget and how it impacts your wallets and your investments. If you have any questions, do drop them here in the comment section, and we will definitely get our experts to answer them for you. Thank you so much for joining in.